All right. I think we're live. Thank you so much. Oh, hold on. Let me see if I can pop out the chat window. I learned how to do this. So I can pop out the chat window and keep it over here so that I'll be able to keep an eye on this. And then now I can get to this and do a little bit like this. And now I think we should be good to go. How is everybody doing tonight? Welcome to another Open Windows live session. My name is Tim Nash. I'll be helping you out. I think everybody knows me. And today I'm so excited. We've got Daryl. Hi, Daryl. Thanks so much for joining the stream.
Thanks for having me. It's nice to be here.
And Daryl Brown is a colleague of mine. We've known each other for, I would say, a few years now, and really kind of following each other's career. I would say following kind of similar paths as sort of investment planners. I think we're both would qualify as investment nerds. And you've been running your own company for a little while, and recently, just over the last couple months, we've had some conversations where you're going to come on board with Good Investing, at least on a sort of a part-time basis, to be able to help me out with some overflow and to be able to bring your expertise to the mix. So really happy that you're sort of on board, and I'm wondering, I'm kind of using this opportunity to sort of introduce you to a number of my clients and people that kind of follow the work. So I'm wondering if you can take a minute to introduce yourself and give people a little bit of a sense of your background.
Sure. So it's really nice to meet everyone virtually. I started my career just about 10 years ago in the middle of the last financial crisis that we had. So back then I was a research analyst with DBRS, Dominion Bond Rating Securities here in Toronto, and having a front row seat for the credit crisis as a credit analyst was fairly eye-opening. And so in that job, I was effectively giving credit ratings for large companies, companies that are primarily in the energy and infrastructure space. And it was sort of there that I kind of, moved a little bit more into the capital markets world. Moved over to Sun Life Investment Management, and again, working with them to do corporate credit analysis. I think from there is where I sort of looked at the energy space and just some of the issues around social responsible investing and ESG factoring, and thought that there might be some different alternatives out there, different way to look at things, and top of just wanted to work with me. So I started my own firm about 3 years ago doing investment planning, and have this opportunity to finally got to form a deeper connection with people in the space like Tim. So it's really great to be working with someone who shares the same values. And yeah, we're definitely hoping to bring a lot of value and insight to the markets nowadays because they are particularly insane. But for the most part, I feel kind of right at home. Started my career in a little crisis, and here we are again in another one. How about that?
Yeah, I mean, it's so fascinating. Oh, yeah, and I'm hearing that there is a big echo coming from your guest, Kelly. We were trying to troubleshoot that. I'm afraid we're gonna have to deal with that for tonight. I wasn't able to get a fix, but we've got some ideas. I'm thinking that's something we'll be able to fix for next week. So I apologize if there is an echo on Daryl, but bear with us. I'm kind of learning this as I go. Hopefully people do appreciate the higher definition. I think that this should be available in 1080p. So I was spending all my time learning about bit rates and how to get the screen as clear as possible. That, of course, I didn't spend as much time on the audio. So I apologize to you, Daryl. I apologize to the listeners that you might have to put up with that echo just for tonight. And we will get that sorted out by next week. Every week, it'll be a little bit better as I figure this stuff out. But for Daryl, really excited to have you here tonight and talking, and specifically with this idea of like having worked for a bond rating agency during the last sort of crash or market meltdown. I think is it fair to assume that there is some degree of I would say caution that you've got? Like when we're talking, you tend to be a little bit more on the cautious side right now, where you're down a little bit. and that really, you tend to be, I would say, a little bit more worried and concerned. Do you think that having lived through that, having been at the desk and watching that in real time, do you think that considered it?
100%. I think compared to 2008, this is a significantly more severe situation. And I think people have looked at the last couple of weeks and they've sort of, they've used words like panic. And I actually don't see that. I actually see the market being fairly rational, and I don't want to say calm, but they are simply pricing in this world that we are now living in, where it's not a financial shock, it's not a shock that's having to do with asset pricing or liquidity. It's actually a real economy that's slowing down, and that's something that's not happened before to this extent. Financial crisis, I like to say the difference is it was paper assets causing the problem in the real economy. This is the other way around. It's the real economy causing problems in the financial markets in terms of pricing, liquidity, corporate credit quality. It's severe, and I think right now the market is pricing in some type of return to normalcy, a little bit aided by the president who thinks everything's going to get up and running by the middle of April, wants to get everything running by the middle of April. I think it's going to continue on significantly longer than that, unfortunately, for the rest of us. I think we've got to do what we've got to do to make sure everyone is healthy.
Oh, and now they can't hear it at all. Okay. Oh. Darn it. Okay, I try to fix. Honestly, we're just gonna have to live with the echo. I'm not gonna try to troubleshoot. I'm not gonna do. It's a little distracting for me. I'll be real. So basically, what I think that it should be okay. Really, just to recap, what I heard there is that that what you're telling me is that we do have. Whereas in 2008, it was a paper crisis that tried to that then turned into a real economy crisis. That really we had a debt crisis that then started to impact spread from Wall Street into Main Street. What we're seeing right now is a biological crisis that is really affecting Main Street, is affecting the real economy first. And then obviously we did see it turn into a Wall Street crisis, sort of a stock market crisis, where things did really dip. And let me just use the charts now that I can use the screen share to be able to do it. But you can see here, here we were, the 6-month chart, September, October, November, December, just coming along so nicely. And then all of a sudden we started to see the market dip, and that we did get this low point, sort of March 23rd. So, this would have been basically Monday by end of day. And then in the last 3 days, we've come up and then up and then up to the point where I think we're up, almost about 20% from that market low. Obviously, we're not nearly back up to where we were, but I do think that, there was this false sense of security this week, where it did seem a little bit like a return to normal. And I think there's like an optimism, like people listening to the misinformation from Donald Trump saying that, okay, everything's going to go back to normal very soon. I'm hearing from people hoping that there's sort of already a light at the end of the tunnel. I'm looking at this personally and I'm saying, whoa, we're still in the tunnel. We're going to be in the tunnel for at least the next 2 to 3 weeks. Everything I'm seeing is that the sort of peak virus cases is going to be in 2 to 3 weeks in the US if we're lucky. And then really we have no idea how long this is going to last. So part of me is kind of feeling that this is a bit of a false recovery this week, that there is this sort of sense of optimism. And I think we're both on the same page, Daryl, that really investors should be cautious, that there will be more bad news, that the good news that we've seen this week with all the stimulus and all the packages, that's pretty much done now. Like, I don't think there's much more they can do. They've sort of opened the barn doors, let all of the animal spirits out, that, the Federal Reserve, the monetary. I don't see too many good news stories coming out in the next couple of weeks. I do see the potential for a lot of bad news stories. Would you agree with that?
I would agree with that. I think that there's, a good deal of the market response was in anticipation of these responses from the Federal Reserve, response from, Congress and the administration putting together a fiscal package. That was, for the most part, I think, if you looked at the results today, I think a good chunk of it was priced in. My concern, I share with you, is that this drags on a little bit longer, and I actually think that there will have to be a second set of stimulus and another set of monetary easing or monetary policy supports that will have to be in place at some point. So I think I might actually be a little bit more bearish than you, Tim.
That's fair. I think we'll get into that. Just to address questions in the chat. So first of all, the company chart, this is not a company. This is the All Country World Index, the ACWI, which is basically an ETF that is pretty much the entire global stock market. So this is kind of the proxy that I use for the global stock market. So, this isn't the US or the Canadian, this would be the global, and that it's not a specific company. I think there's about, 2,300 companies inside this ETF. So this really is sort of the broad, we can get into that. In terms of the audio, everyone, I'm sorry, and I know it's not ideal. I can't turn off my mic. I'm kind of dealing with things on a few different levels here with this, present speakers wobbling, feedback. Okay. So, Daryl, I apologize. I think I might have to say goodbye to you for tonight. Let me work on the audio, and we'll get you back next week, okay?
We'll catch you next week.
All right. Thanks so much, Daryl.
All right, take care.
Bye-bye. Okay. Sorry, everyone. I was hoping that Daryl could stick around and do the questions, but if you're just getting feedback, then obviously it wasn't worth it. I'll work on that. We'll get Daryl. I would love to be able to share his insights with you. He's a brilliant guy, so being able to get him in is great. I knew that was going to be a bit of a pilot project. I apologize to your ears for bearing with that. So hopefully this is okay. Basically, let's just get to the questions. Let me just kind of go through it. Daryl and I had been chatting a little bit about them ahead of time, the ones that did come in. So what we'll do is I will make sure that sort of his perspective is included. Yeah, okay, no problem. I'm glad you did that. Okay, no worries. We'll get through this one thing at a time. So what I want to do is, really, I want to start with a bit of a checklist that I've been using as I deal with clients who have some cash they want to put to work. What we want to do is basically go through a checklist before you put any more money to work. The first question is, how stable is my income? In the crash, some people's jobs are going to be harder hit by this. Others won't be as hard. So obviously this is a huge concern for this. Number two is my emergency fund topped up? I'm not going to let anyone invest money if they don't have an emergency fund right now. This is one of the most important things when you need to have your emergency fund. Typically, I tend to think that 6 months is enough and good to go. That said, Daryl, his perspective, he really wants people to have 12 months emergency fund. So, if we can do 12 months, then that would be the best. But, I would be comfortable as long as your household income is fairly stable. And the last point, you've got a long-term horizon. I would be okay with about 6 months, but Daryl would err on the side of caution and want you to have 12 months emergency fund. From there, it really comes down to the long-term horizon. Do you have a long-term horizon? Obviously, things are going to get really wonky over the coming weeks and months and, potentially even year or more, right? We just don't know how long this thing is going to last. So, really I'm looking for a long-term horizon here, 5 years, 10 years, 20 years, 30 years, 40 years. If you're one of these decade-long investors, then, that's when I would feel a little bit more comfortable, knowing that if it does fall down further, that would be okay. You would be fine. You would wait. I'm going to go through the questions that I got through email, and then I know there are some questions in the chat here at the top, so I will get to those, I promise, but let me address the questions I got via email. So I got a question from Karen, and it asked me the question, should I rebalance even if I don't want to put new cash in? So really, Ken, the answer for you here is, of course, the old adage from economists, it depends. Basically what I want you to do here is to do the math. And really what I'm looking for is to see whether your stock bond mix is appropriate. So you don't have to do the full rebalancing, put in, the market value for all the different things. Really, all I care about is your bonds. So we would take the market value of your bonds, and what we would do then is basically divide that by the total market value of your entire portfolio. So it's basically going to be like market value of bonds divided by market value of the entire portfolio. And this is going to give you your percentage bonds as they exist right now. And that if we were aiming for, let's say, 40% bonds, 60% stocks, and you do the math and you say that, hey, you're at 40% bonds, then great, you don't need to rebalance. You don't need to worry about it at all, right? Even if you're close to 40%, if you're like 39 or 41, then no problem. It's really as we start to deviate from that asset mix, that's when it is a little bit of a problem there. That really what we want to do is, and it's hard to know exactly what the benchmark is in terms of when you should absolutely rebalance. But certainly I would say if your bond mix is like 10% off from where it should be. So if you were aiming for 40%, I'm not saying let it get to 30 or 50. I'm saying, 10% of 40 is 4%. So if you're deviating more than 4% in terms of your bonds, then you absolutely should be rebalancing right now. If it's any more than like 2%, if it's between like 2% or 4% off, then I would say you probably could. You don't have to, but you probably should. But if you're more than 4% off, so if you're less than 36% bonds, or if you're more than 44% bonds, that to me is a signal that, okay, now it's time for you to rebalance. Really what it comes down to is sort of how good you've been at it. If you've rebalanced recently, then you should have a lot of bonds in your portfolio right now. Again, the reason why we own stocks and bonds, so I'm going to take this All Country World Index, which is the proxy for the global stock market, and I'm going to add in a government bond ETF that a lot of my clients own. I'll make this one purple. And you can see here that, as the stock market crashed, your bonds have stayed very, very stable. In fact, they might have gone up in value by a little bit. So if you were at your 60-40 point here, chances are your stocks are down, that they're not at 60% anymore. They might be down to like 55 or 50%, At that point, it would make sense. Like your bonds are going to be at 45 or 50%, right? So chances are that would be a good time to rebalance. However, if it's been a little while, if you've been a little bit lazy, right, then obviously our stocks have done quite well compared to the bonds, right? And if we look at it over, let's say, a 5-year period, now this bond fund isn't going to be there. So what I'll do is I'll do the comparison. I'll do XGB that I know is older. Oh, .to, will it pop up? There it is. And I'll make this one the purple one. It's been around a little bit longer. So you can see that, if you invested in 2016, well, obviously your stocks, went all the way up. You should have rebalanced when they were up here. But if you didn't bother, we're kind of back to where we started to some degree. So this is why it really depends on the last time you rebalanced, right? And it really does depend on your stock to bond mix. So really what I would do is do this little formula, your market value of your bonds divided by the market value of your entire portfolio. And if your percent bonds is way off, it's time to rebalance. If it's pretty close to where you want to be, then don't bother. You can just sit through this and just kind of cruise through. Hopefully that makes sense. Next question here from, I believe it's Birte. So talking about some of these renewable energy utilities, Algonquin Power, Northland, Capital Power, all went down over the last 2 weeks. They're bouncing back now. But we were surprised since we thought that given they have rate guarantees in Ontario on power production, they wouldn't be affected by the virus. Any thoughts on this? Okay, so what you got to understand is what's going on, and let me just bring up the chart here. So the one I know the best is AQN, Algonquin Power and Utilities. And we can look at them, and let's look at them. You can see over 5 years, hey, not bad. But if we look at it just over the last 3 months, here's what we're talking about. So what happened is that prices did come up, but then like everything else, prices did plummet. And it was especially in sort of the second round of the little decline here that they really came down. What I would argue is that this was basically systemic risk, From there, what we want to do, really it is this systemic risk. So when the stock market fell, everything fell. That really, when it comes to this idea of systemic risk, there is no such thing as a safe harbor within the stock market. When it comes to bonds, when it comes to gold, these other asset classes, right? That's where there might be safe harbors. But when there is a crash right now, the whole global stock market is so interconnected that I do expect everything to fall quite drastically. But if we look at this over the last 5 days, you can see that it really has jumped back up. So what I would say is that over the last few days, I think the market has agreed with you that, probably this got hit further than it should have. And what we've seen is that companies that did, I think a lot of investors kind of went in there and had their shopping list and bought some of these stocks that they do think are going to weather the storm quite a bit better, which means that, that's why the price actually came up more than the overall market. So again, if I'll just show you in comparison to this all country world index, so this is going to be compared to the entire global stock market. I'll make it orange. That you can see here that a company like Algonquin has remained more stable. It didn't fall as much as everything else, but it did fall with the stock market. But now it's bumped back more, such that, at this moment in time, at end of day yesterday, it's really only down about 3% from where it was 3 months ago, whereas the rest of the global stock market is down 20%. So this is this idea of systemic risk, that everything's going to get hit, everything's going to come down, but that these more defensive stocks, right, probably, and we're hoping would remain a little bit more stable if there is continued uncertainty. One thing I do sort of want to tease is that I'm looking at doing a bit of an idea. This will be sort of written pieces, likely for the Toronto Star. I'm coming up with this idea of a pandemic-proof portfolio and starting to identify certain companies that I think are going to be able to withstand a prolonged pandemic. If it is a bad case scenario, right, that this is going to go on for months and months and months, I'm seeing there's certain companies that haven't been as hard hit by this. For example, one that's on the top of my list is Cascade. So this is a toilet paper company. They make paper products, all kinds of different paper products. You can see that over the last 3 months, hey, they're pretty darn stable, right? Look at this. How many stocks are largely unaffected by this crash? Even with things going down, it really has stayed remarkably stable. So, I am going to be playing with this idea of sort of these, pandemic proof companies that obviously I prefer ETFs. I like the diversification, but I do think that we're about to enter into a new sort of economic reality right now, which is why, I do think that we're going to be able to, identify some companies, not to like get rid of your ETFs and do all these, but maybe carve out part of your portfolio for certain positions that, I would expect to be a little bit more stable, even during a prolonged pandemic or recession that it looks like we are going to be getting. So hopefully, can I send that virus-proof portfolio out on your website, John? Yeah, I'll be putting out newsletters. I'm actually hoping to do probably about 3 or 4 companies, I would say every couple of weeks, likely with the Toronto Star and Corporate Knights. So I'll be sending out newsletters for that. And that, maybe once I get enough companies on the list, I'll turn it into a blog post or something like that. But I would say stay tuned. That's not something I'm in a huge rush to do. Obviously, I have a lot on my plate right now, but that is kind of where my head is at, and I am starting to look for those options. From there, I do have a couple questions from Vince before I get to the questions from the chat. And by all means, feel free to put some more questions in the chat if you have them. But basically, question number 1, considering the exchange rate that isn't that great at the moment, is it wise to hold off on purchasing US listed ETFs? Oof, so this is a tricky one. So when it comes to the exchange rate, it's not pretty right now. The website I use is xe.com. And, if we want to look at the Canadian to US market, here it is. It's 1.405. Now, I would say that this has actually improved a little bit. It was worse over the last little bit. Let me look at the last week. And I can see here, over at about 1.45. If you look at the screen, up at the top, it follows my mouse. But up at the top, the close was 1.45, right? If we look at the last month, where it was before, it was at about 1.32, 1.33, 1.34. But then as we got into the market, really what's happened is the oil market has crashed. And that the Canadian dollar is considered still a bit of a petrodollar, which means that the Canadian dollar has gotten weaker, right? Now, it's interesting, over today, it went from about $1.45 down to about $1.40. So Vince, depending what time you wrote the question, it might be a bit of a better time now. But I just want to be clear that when it comes to Canadian dollars or US dollars, it really doesn't matter. We're going to be exposed to the currency risk no matter what. That if we own a Canadian dollar ETF that has US companies inside of it, we're still exposed to that currency risk no matter what. So in my mind, really with this exchange rate, it would impact more the allocation to US equities, not so much a US dollar ETF. So in my mind, it's a fine time. I really wouldn't worry about the exchange rate when deciding whether to do a Canadian dollar ETF or a US dollar ETF. Instead, what I want to know is what kind of companies are inside that ETF, because that'll really tell me the currency exposure that I'm getting. Really, when it comes to whether it's in Canadian or US, that depends on how I buy it and how the reporting is done. But at the end of the day, the value, the actual exposure that I have is based on those underlying assets. So for example, I think likely the ETF you're talking about is SDG, which is the iShares MSCI Global Impact ETF. And when we look at what's inside this one, this is in US dollars, but it's got a fairly low exposure to the US. It's got more exposure to Japan, UK, China, France, Denmark, more than the benchmark, right? So what this means is that you're going to be about 30% exposed to the US dollar, but you're going to be about, 14, 15% exposed to the yen, and about 8% exposed to the pound, and 8% exposed to the Chinese yuan, the RMB. So really it's the type of thing where I care more about the underlying assets much more than I care about the currency of the ETF. Hopefully that makes sense. From there, I consider it too risky if a person with a long-term horizon simply holds ETHI as a one-fund solution. Oof, ETHI, I love it as an ETF, but it's not very diversified. It's only got 100 companies inside of it. Here it is. So when we look at ETHI, this is the Horizons Global Sustainability Leaders ETF. I do love this ETF. The issue is that it only has about 100 companies inside of it. I don't know if it's going to tell me, but I can tell you that it does only have 100. I've looked at it. So to me, it's not ideal as a one fund solution because there are no bonds in here, meaning that if you do only this ETF, you're going to be only 100% stocks, right? And so to me, I would feel much, much better if you paired this with a bond ETF. And even if you are young and you've got a long-term horizon, doing 80% stocks, 20% bonds, I would feel so much better about that rather than owning just this one ETF. So, you can do it if you want. There's a lot of risk. I would strongly urge you to pair this with ideally a bond ETF, and then ideally something else that does give us a little bit more broader exposure. Hopefully that answers your question. I think that's all the questions I got from the email. So I can now go to the questions from the chat. So hi, Olivia. It's actually Eric on Olivia's account. Okay, fantastic. I'm thinking that I'd like to switch my XGB bonds for those with a lower MER, e.g. CLG. Would that be risky to do during these volatile times? So first of all, let me just show people what he's talking about. Eric owns XGB, which, for the longest time was really the best sort of diversified bond ETF, that it is going to be a mix of short-term, medium-term, long-term. So you can see here, short-term, medium-term, long-term. It's also going to be just government, provincial, federal, municipal, right? The issue is the fee on it, this MER, 0.39%. which is not outrageous, but it is very expensive for a bond ETF. So what he's suggesting is instead do something like CLG, which is an ETF that I've got on some of my model portfolios, the 1 to 10 year laddered government bond index ETF. The issue with this one, Eric, so you're totally right that the fees are cheaper. You can see here 0.16%. Hooray, much cheaper, which I like. The issue with it is that it doesn't have the long-term bonds. That because it's a ladder, it is going to be more sort of like short-term, medium-term bonds. It's not going to have the exposure to long-term bonds in here, which like right now, long-term bonds, I mean, it's not the end of the world for you to not have exposure to that, but that would be sort of the sacrifice that you're giving up here, is that you don't get quite as much diversification there. The ETF that a lot of my clients are liking right now is ZGB. This probably wasn't available when we worked together because it only came out, I think, a couple of years ago. ZGB, here we go. So you can see here, this is the BMO Government Bond Index ETF. This is going to be a little more appropriate just because it does, again, provincial, federal, municipal, but it does have the mix of short-term, medium-term, long-term. And what's great about this is that it is cheaper, that it's about the same MER, 0.17% here. So again, very, very similar to that CLG. So you might consider this one instead of CLG. Really, it's up to you. I don't care too much, but this one would be a little more diversified. In terms of doing it during these volatile times, I'm not as worried about swapping out your bonds, that your bonds do tend to be a little bit more stable. And really what I'd want to make sure is that you sold the one bond ETF and then bought the other one right away, that I don't want you to wait at all. Just because we do, anytime we're replacing an ETF, it's not a big deal. These things are going to fall so close to each other. Like, let me just show you xgb.to, which is, Eric, what you currently own right now, right? And then compared to zgb.to, which I'm going to make in purple. These things follow so closely. You can see why, you might as well go with the cheaper one. I would support that. And really, as long as you're buying or selling at the right time, at the same time, it doesn't make a huge difference. There's a bit of a price gap here, but that's pretty rare. I wouldn't expect that to happen too much. That's probably just that maybe like no one was buying it, so it didn't record the price sort of throughout the day. But it's the type of thing where as long as you're basically selling it and then immediately buying the other one, I've got no problem with you making that swap, especially since it is sort of a longer term holding. That's something that you're going to hold for a very, very long time. So I've got no issues with you making the swap. I just want you to do it sort of as quickly as you can. Hopefully that helps. Okay, Eva, DRFG, you want to look at that one. Let's look at drfg.to. So, okay, now the pricing on this one is going to be a little bit funny because, again, there's not a huge amount of volume in it. But I did speak to Desjardins about getting a little more liquidity in the fund. And this is good. These little candlestick bars down here, these are the liquidity. So these are when people are buying or selling. And I'm happy to see a little more action in this one. So this does help. So in comparison, we're going to look at the All Country World Index, which is my benchmark. So I'll make it purple. So again, DRFG is the blue line. ACWI is the purple line. Now, they are slightly different currencies. ACWI is in US, DRFG is in Canadian, so it's not perfect. But really what I see here is that DRFG, which is awesome. And really a big part of this is going to be because DRFG doesn't include any energy. And energy has just been dragging everything lower. So there are a couple different energy ETFs. What is it? XEG, I want to see. So this would be like the Canadian one. How do I make this? What's like a dark color for oil here? Here, I'll make it this like deep red. And you can see, Canadian energy has just been awful, right? So it's the type of thing where obviously because we didn't have exposure to this, look, down 64% in 3 months. Like, wow, that's rough. So obviously, because with the Desjardins one, hey, we divested from fossil fuels, good for us, it didn't fall nearly as much. But then you can see here, it hasn't bounced back up quite as much, and I'm surprised that it's flat today. I'm a little bit surprised there. If I look at it, trying to look at the blue. There are a couple dots here, but so I'm not too sure on the pricing. I'd want to see. Whoa, that looks quite bad. Here we go. I think the 3 months is going to be the most appropriate chart here. But what I would see is that DRFG didn't dip as much. And then let's see how it goes in terms of, especially with today coming back up. It wouldn't surprise me if the number here is just a little bit off. Let me just look at it through here. No, 1754. So look at this. So in terms of the price, it hasn't updated today at all. So you can see this is as of this morning. So in terms of their data for their chart, for whatever reason, they have it flat today, but I would expect it to be a little bit higher, which is why when we compare it to that All Country World Index, you can see that it's good that we're lucky, right? We didn't own any oil, that it didn't dip as much. And then I am expecting DRFG probably did come up today so that it would have, probably been beating the benchmark over the last little bit. Hopefully that answers your question there. Let me know if you've got more questions. How are we doing? Do we have any more questions from the chat? I'm not seeing anything here. I'm hoping that I'm still recording and that everything is going well. Let me just check in. I've got 32 viewers, so I think everything should be good. Is it safe for me to assume that people are good to go, that we don't have any more questions at this moment in time? How's everybody feeling with this? I know it has been a bit of a tricky week. It's been very challenging. And I think it is going to get more challenging over the next little while. So really, what I would say is that you do kind of want to stay put with this. That really often the best strategy is just do nothing. If you feel compelled like you have to do something, then I want you to stay calm and rebalance. That's going to be the trick. If you're thinking that you do want to put more money to work, I really want you to go through this checklist before you put any more money to work. Really, it's about how stable is my income, is my emergency fund topped up, and do I have a long-term horizon? And only if these three things are all ticked, that's when you have some permission to get a little bit aggressive. But I really do want people to use this, I would call it dollar cost averaging, that we really don't want to guess when the bottom of the market is going to be. That instead what we want to do, the analogy I'm using right now in terms of timing the bottom of the market, is that we're throwing darts at a dartboard and we're blindfolded, right? Nobody knows where the bottom is. Nobody knows. So we're blindfolded throwing darts. And the last thing I want you to do is to put all of your money in one dart and let it fly, right? Instead, what we want to do is split up your darts and instead to do a number of different things about kind of how, basically if we can split it up into 3 darts or into 4 darts or 5 darts, then what we're doing there is obviously, spreading them out over time, doing it on a schedule, or if you notice that there is a particularly bad day in the market, that might be a good day to kind of throw a dart at there. But I don't want you to put all of your money to work, right? Really, I do think we should spread it out. Is kind of my instinct on this, especially with things that as they are so volatile right now. Hopefully that's helpful. I do see a comment from Rudy here. It is a tricky week, and I'm thinking about the comments about how it is going to get worse again. And, I don't know for sure. I don't want to be like the pessimist here. I was talking to my dad today. He's kind of optimistic. Hey, maybe I'll be able to get my dad on it here in terms of a guest if I can get this audio thing sorted out for next week. Maybe I'll get my dad on here. He's been through more crashes than I have, and he's feeling a little optimistic. That said, I'm not. That I'm kind of tracking the science and I'm tracking the pandemic. And really, for me, everything I'm hearing from medical professionals is that they're getting ready for a much bigger crisis in about 2 to 3 weeks. That's when, shit's really going to hit the fan. So if we do have, if it is going to get worse before it gets better, then it's the type of scenario where we do want to have some darts available in case things do continue to keep going down. Okay, I'm getting a couple last questions here. Fantastic. Okay, so a high interest account in a nice bank other than Alterna. Yeah, so I wrote a blog post here. I can show you, sustainableeconomist.com. My puppy Irie here is paying us a little bit of a visit here. So, okay, in terms of this, what do I do about coronavirus? So you can see here, what do I do with my cash in the meantime? For you, there is a great comparison chart. So if you click on this, this is going to be a list of all the high interest savings accounts in Canada. And you can see here the rates, they seem to be coalescing around about 2%. I've got my money with Alterna Bank, not Alterna Savings, Alterna Bank. Oh, and we're getting a little visit here from Irie. Hi, girl. Nice catch. There you go. So hopefully I can keep her busy for a moment here. But basically, this is going to be your list of all the different high interest savings accounts. So this would be the list that I would go to in terms of these different places to put your cash. The other thing, Eva, there was a ticker that is kind of like a high interest savings account. So I have that in this blog post as well with these high interest savings ETFs. There are two of them that we can look at. The first one is this one, PSA, which is here. The second one is this C-Save, which is here. The last time I looked at them, Purpose had a fairly low yield, so 1.15 with a management fee of 0.15. So they are, the yield on it, basically the net is like 1%, which obviously is not great, but it's fine. C-Save is going to be a little bit better. Oops, here we go. Where if we look at what's in here, again, it's all these different like cash accounts. So it's an ETF, but instead of a cash ETF or a bond ETF, this is a cash ETF. This one is paying 1.25% with a management fee of 0.14, so it's basically 1.11. But this would be the equivalent of a high interest savings in an ETF, C-Save. Really, if the money isn't in an online broker, if it's not in an RSP or TFSA, if it's just like cash in a checking or savings, I would much prefer to do these traditional high interest savings account. I would prefer these. Obviously, the rates are higher, but these are also going to be insured by something called the Canadian Deposit Insurance Corporation. So the fact that they're insured means even if the bank or the credit union goes bankrupt, your money's still safe. Whereas with these ETFs, it's not insured. So, there is the chance if these banks went bankrupt that you would lose part of your money because it's not insured. Obviously, very, very low probability risk. But I think you understand why I am telling you that, if it's up to me, if it's not in an online brokerage account, right, then I would probably prefer to put it into one of these high interest savings account so we can get the higher rate and get it insured. From there, impact bonds, good time to buy. So yeah, I think so. So I did a little piece for Corporate Knights about this. So we're basically, are they a good thing, that they offer a bit of shelter in this time? Oh, oops, I'm getting my, sorry, all these typos. I get nervous when I'm live. I gotta slow down, take a couple deep breaths, make sure I get my spelling right. So here we go. Impact bonds offer a safe haven for investors. So yeah, I feel pretty good about these impact bonds right now. The fact that they're just completely uncorrelated to financial markets, to me feels pretty good. You can see there are a few options that are available. CSI, Sketch, Rudy, you've on here. I don't know if you've got an update at all that you want to provide in the chat window. Maybe we can have you on as a guest on this show if I can get the audio sorted out. How cool would it be for me to start having guests on here? If there are, show ideas or guests you want me to have, then by all means, feel free to let me know via email or in the chat window. CoPower just sold out, so good on them. They sold out their $5 million bond like super quick, but I do think that Solar Share bonds are still available. So I'm feeling good about these. Really what you want to do is make sure that you are comfortable with the worst case scenario. So my only concern here, with CSI and Sketch, obviously these are physical locations. So, I would ask them, I would want to bring up to them to be like, hey, like, if there's what's the drill right now? Are you, or do you still have any income coming in? I know CSI has closed. I can only imagine Sketch has as well. What I would say is that these things are really, really, really important right now. So I feel like the impact is very high. But obviously, I would want to check in with the organizations to make sure that the risk level, that in terms of the value of the bond and the property and everything like that, is still very strong. Uh, Fantastic, Rudy. That would be excellent. Happy to do it before your bonds are sold out. Yes, I do expect Sketch bonds probably are going to sell out. CoPower sold out very quickly. So, what I would say, Felix, is that if you did want to get in on this, I would say I'd want to go through the same 3 questions. How stable is your income? Is your emergency fund topped up? Do you have a long-term horizon? These things are not liquid, meaning that you can't access them in an emergency. But, provided that your cash flow is good, that you feel safe, you feel secure, you've answered yes to all of these, I would say now could be a great time to buy bonds. Especially since the interest rate, right, has stayed the same. The interest rate on all these other bond funds, on everything else, has gone down over the last little bit, whereas the interest rate from these impact bonds is going to stay the same. From there, last thing, Anthu here, can I give an example of a long-term horizon? I would say at this point, normally I would say at least 5 years, that it can't be shorter than 5 years. If it's shorter than 5 years, cash. I don't know how long it's going to take for things to come back up. At this moment in time, I might even stretch that. I would say anywhere from 8 to 10 years would be a longer term horizon. Oh, hold on, I'm getting some banging in the background. And that from there, what we would do is really look at it, at least 10 years for now is what I would say. That we don't want to have any more than 10 years. That we wouldn't want to have any shorter than 10 years. Okay. I think that's it for me. I think hopefully these are all the questions. This has been fantastic. This video will be available after the fact on YouTube, on my YouTube channel. As well, what we're going to do is hopefully clip out the little bit. So if the audio was really bad with Daryl, I might just clip out some of these questions for people and just kind of put them up on the on YouTube as separate videos. So expect to see more of this. I'm just going to plan to keep doing this sort of same bat time, same bat channel. Thursday night at 7 p.m. kind of seems to be the way to do it. And from there, I'm going to let everybody go. You have a wonderful evening. Have a wonderful week. Stay calm. And we'll talk to you next week. All the best. Bye-bye.